As markets are sitting near all-time highs, still, there's trouble in paradise. We do have a new update from Fundstrat and Tom Lee and how they're gauging our markets. But I gotta say, I disagree with Tom Lee on this one, to some extent at least. Fundstrat wrote this post on X and Tom Lee shared it. They say the CPI, PPI, and New York Fed reports show so much disinflation, markets are skeptical. But this week reinforces our view inflation is falling like a rock equals supportive of higher PE into year end. This week, 3 macro reports highlight a significant step down in inflation is underway, underscoring our base case that inflation is tracking lower than consensus and lower than the Fed realizes. Which I do agree with this. Disinflation is here and it is happening. And I do agree in practice that should cause PE multiples to go higher. I would argue that PE multiples need to go higher in small caps and interest rate sensitive stocks, and that's just not happening. And yes, Tom Lee agrees with that. Small cap stocks and interest rate sensitive names are likely to outperform as inflation starts to fall. Now, Tom Lee and Fundstrat did not outright say that means the S&P or NASDAQ on a headline basis is going higher, but I can assume that's what they're getting at here. And that's what I, to some degree, disagree with. Earnings expectations for 2025 and this year have risen throughout the year, which is statistically abnormal. Expectations start off a year optimistic on the high side and then actually tend to fall throughout the year, which that doesn't necessarily mean stocks need to fall from here. That's just saying the bar is higher than ever. The part that's actually hard for me to wrap my mind around and agree with Fundstrat on is this. Tom Lee shared this post today from Zero Hedge that says, University of Michigan's buying conditions for durable goods crater. The Fed is officially behind the curve. And that's the hard part, because if the Fed is behind the curve, and Tom Lee believes the Fed is behind the curve, which it looks like he does, then it's very hard to make an argument that stocks will go higher when the Fed cuts rates. Because it seems obvious to me, and history would suggest, that when the Fed starts to cut rates, stocks actually fall big time. The S&P 500 typically falls about 23% over the course of 193 days following the first Fed rate cut. That's because normally the Fed cuts rates when something breaks, and judging off of the press conference we had this week, that's what it sounds like the Fed is waiting for, some kind of unexpected weakness to start their cutting regime. And if that's what the Fed does, they actually wait for some unexpected weakness, that will not be good for stocks. And it's virtually unprecedented. The Fed cutting rates at the right time to avoid an economic downturn. If that was the case, I think the Fed would have cut rates yesterday, or very much implied that they were going to cut rates coming July 31st. In fact, judging off of this University of Michigan data that we got today, it may be too late by July 31st to cut rates and avoid a recession. According to Michigan Consumer Sentiment for June, so this month, we were expecting a headline number of 72. You came in at 65.9. Last month, you were 69.1. So we actually expected sentiment was going to get better, not 4 points worse. And if you take a look at Michigan Consumer Sentiment, it is firmly on a downtrend ever since hitting those highs around March of 2024. It is also strange because this survey tends to follow pretty well what stocks are doing. When stocks fall, sentiment tends to fall as well, and stocks are sitting near all-time highs. What's more alarming is Michigan current conditions. They were expected to come in at 70.5. Last month, they were at 69.6. So you were actually expecting current conditions to rise, things to get better, people to feel better about the current state of the economy. And they plummeted to 62.5. This is by far the lowest point we have been at in the last 12 months. Besides June of 2022 and the subsequent following couple of months, you are at the lowest point that you have been at in the last 5 years. And just to put this into context, you're at the same level of pessimism, if you will, about the current state of economic conditions as you were during the bottom of the '08 recession in November of 2008. And that's the hard part, because with the Fed seemingly reluctant to want to start cutting rates at all, with people feeling this poorly about the economy, eventually we'll start to see the economy reflect data like this. I mean, let's just ask ourselves, how long can Michigan current economic conditions be this low, like great financial crisis lows, and that not affect the economy? I think the question is when and not if. And I should also point out the last time current conditions were this low was really a downturn from the start of 2022, January to June. What actually happened during this period of time is you were actually in a technical recession. You're getting a more just straight down nosedive than you even did then, and were apparently far from a recession. At the same time, the Atlanta Fed GDP Now tracker is estimating over 3% GDP for Q2. I mean, something is just not adding up here. You also had Michigan consumer expectations that missed by a large margin as well. You were expecting 72. Last month, you were at 68.8, and you came in at 67.6. 1 year inflation expectations came in the same as they did last month at 3.3%. That was also the estimate. But 5-year inflation expectations were expected at 3%. Last month, they were at 3%, but now they're at 3.1%. So basically, an economy that is worse off and higher inflation. And if you guys want my honest opinion, this week's Fed meeting, I was expecting a Jerome Powell that was going to be a lot more considerate of the actual economy, of the actual data out there. The household survey shows 650,000 jobs have been lost this year. That is full-time jobs, and about 280,000 part-time jobs have been added. The Fed just seem like they want something to break. And I think the markets need to start at least coming to reality that a soft landing is probably not possible here. And I think there is a huge disconnect between that, with stocks on an index level trading at or near all-time highs, and the 0% probability of a recession that markets are currently assigning. We have to start at least asking the question, is there a greater than 0% chance we go into a recession? The obvious answer is yes, so that means you could see more pricing in of a recession in the not so distant future. Now, take a look at this. It's from DRW. They wrote, Powell has no room to get hawkish. Unemployment rate is 0.6 off the cycle low. In the last 4 cycles, omitting the pandemic, when the rate was up 0.6, momentum took over and the rate rose from that point on with a fury. So what you can see here is every time in the last, 30, 40 years that you rise 0.6% on the unemployment rate, that seems to be the breaking point where a lot more people start to lose their jobs thereon after. Well, you've went from 3.4% to 4% unemployment. It could start to accelerate now. If you look at '01, same was true there. You went up 0.7%, 0.6%, really ticked down a little bit up to 0.7%. It was way higher after that. 1990, same is true. You got an exponential rise in unemployment. 2007, same was true. That's a compelling argument. It seems like to me we could be one more tick higher in unemployment, and the markets may start to ask that question, whether or not we are actually going into a recession or not. After all, in this week's summary of economic projections, the Fed is still only projecting a 4% unemployment rate for this year, meaning they're not expecting it's going to rise anymore. They're not expecting it's going to fall anymore, that it's just gonna stay the same. Now, again, I don't want to come off too bearish or too hawkish, but I do think when you have a market like this where it seems like there's no risk priced in to markets on a headline basis, you want to be a little cautious. Now, of course, if you look at IWM today, it's taking a beating. IWM got punched in the face, down 1.6% at the time of recording this video. Parts of the markets are discounted for a recession. Parts of the markets are not. I think part of this unwillingness to price in recession risk comes down to big tech. Investors are looking at big tech and especially AI stocks, and they're saying there's no way, recession or not, Nvidia's demand will be impacted. And I am here to tell you that is 100,000% incorrect. Especially after all of these AI companies already have, to some degree, the GPUs they need. If you start to go into a recession, companies will pull back. They will pull back those extra NVIDIA GPUs that maybe they don't need right now. That will happen. Microsoft, let me remind you, in 2022, went from a $350 stock down to $212. Apple, same is true, seen a big decline during 2022. And Apple was kind of the stock that held up the best, let me remind you, from about 182 down to about 120. Google, same thing, from 153 down to 83. All of these stocks seen big declines in 2022, when at one point Bloomberg was reporting a 100% odds of a recession within the next 6 months. So I do think there is a big disconnect between what could happen and what the markets are pricing in. I mean, to some degree, I understand if the markets are more optimistic that Nvidia would do okay during a recession because, I mean, there is an AI race here, but Microsoft, Apple, that's consumer cyclical all the way. I mean, Google, I mean, I'm making a video that's posted on YouTube that Google owns. Like, I have no incentive to talk negatively about really any of these companies. People don't like the negative Nancy, and I don't want to be the negative Nancy. But the more data that you're starting to see suggesting we could actually go into recession, the more I question the markets assigning a 0% chance of a recession. I mean, is it 10%? Is it 20? Is it 30%? Literally right now, if you look at markets, there is a 0% chance of a recession within the next 12 months, just based on where markets are priced. EPS expectations, PE multiples. I mean, this is right in front of us. Nobody should argue that. Should we say it's 10% chance of a recession within the next 12 months? Is that egregious? Probably not. Is 20% egregious? Probably not. Is 30% egregious? Probably not. What happened to the S&P 500 in 2022 when Wall Street was pricing in a 100% chance of a recession by October of 2022? Well, from peak to decline, you've seen a decline of about 26.5%. Now, I think that's dangerous because, I mean, yes, we were kind of elevated as far as valuations and all of that in 2021. Stocks ran a lot, but there was also a lot of money printing. There was also a reason valuations were that high. Well, today, you've seen areas of the markets get utterly destroyed already, like small caps. There's not a lot of money in certain areas of our markets. All of the money is pooled into big tech. If recession risks start to rise, the fall could happen quickly if the markets start to realize big tech is not as safe as we think. And back to my point, again, Tom Lee may be correct. Stocks may rally off the first cut. But if the Fed is cutting because some kind of unexpected weakness, which seems like the only path right now to actually getting a cut from the Fed, that's not going to be good. And I know I'm going out on a limb here. Stocks are near all-time highs. Certain areas clearly are not, like small caps. Your average stocks are not. So I'm not expecting a lot of people are going to like this video. Those are precisely the videos you need to pay attention to. When someone challenges the consensus view of markets. Like, in all reality, if we start to go into a recession, if the Fed cuts rates because of some kind of unexpected weakening, if the unemployment rate does start to move higher, causing recession fears to rise, who's to say we could not get back down to October, November lows, which would be a drop of about 25% from here. I mean, on average, when the Fed cuts rates, the S&P does fall 23% because it's usually coming based on something breaking. So I don't know what's going to happen. I don't. But I do think over the next 2 to 3 months, as we get another round of economic data coming out, another round of earnings, I think the risk is elevated that the markets are not paying attention to, that we could be going into a period of economic problems. And I do think for downside here in any kind of material way, let's call it 10, 15% downside from here, I don't even think you have to have the markets turn to a consensus view of a recession, like over 50%. If today's odds are 0%, I think moving up to 20% odds of a recession, 25%, 30% odds of a recession. If just 1/3 of investors said, hey, it's possible we could have a recession within the next 12 months, I think that could bring down markets 10 to 15%. I don't know, maybe I'm just letting the bear side of me get the best of me today, but I really don't like the data that came out today. I really don't like small caps getting utterly destroyed, even as inflation this week has come in lower than expected. I do not think that is a good sign for broader indexes or the odds of a recession. Because in all reality, if things were going fine, small caps should actually be outperforming right now. If the Fed was not planning on cutting rates anytime soon because, well, they need more time to figure out inflation and the economy is doing just fine, small caps should be doing well on that. In fact, small caps got punched in the face today, down almost 1.7%. That's because the Russell 2000 is seen as an economically sensitive index. You are also seeing the VIX that is up about 5% today, as the S&P 500 is marginally in the red. And what that means is investors are buying more puts on the S&P than calls today by a pretty large margin. CNN's Fear and Greed Index today is at 38. Yesterday, it was at 43. So you're right in the middle of fear between neutral and extreme fear. The percent of stocks trading above their 50-day moving average is only at 35.89%. So only 35.89% of stocks are above their 50-day moving average. In fact, 6.4% of all stocks out there today are falling under their 50-day moving average. Just for a little bit of context here, the S&P 500 on an index level, just to get down to its 50-day moving average, let alone under its 50-day moving average, that would be a decline of about 4.1% from here. So at the same time, your average stock is not doing well. It has not done well in a long time. And specifically since about mid-May, your average stock has been doing very bad. The indexes just keep doing okay. And again, the obvious reason for that is because if we were to go into a recession, well, big tech's your place to be. Big tech has all of the AI benefits, presumably, or presumed by the markets. So that's your place to be. And there's other reasons as well, but if we actually do go into a recession, or it looks like we are going to, those big tech names are not going to save the markets. And judging off of the average stock not holding up well, if you did start to see big tech give up, have some big down days, yeah, there's just not a lot of strength there. It's kind of like a house, like a beachfront house that is built on 30 stilts. Well, right now, like 15 of them are knocked down. If you start to get more getting knocked down, eventually the house falls quickly. To put it into an analogy, that's kind of what this market is starting to look like. And let's be honest, it's looked like that for a long time. The thing is, there hasn't been a reason for those stilts in this analogy to continue to break. Economic data suggesting a recession could be coming is just that reason that could happen. And again, the Fed just unwilling to acknowledge that inflation is going away, that the Fed keeping rates higher for longer is actually hurting inflation, not helping inflation by keeping rents elevated. It seems like the Fed is totally disillusioned and delusional to the actual state of the economy, of interest rates, of inflation. I don't think the Fed has a clue what they're doing. And unfortunately, I have virtually no faith in the Fed to guide this economy away from a recession into a soft landing. Recession precursors are there. I was optimistic that the Fed this week would be a little bit more on the dovish side, would be a little bit more willing to accommodate the economy. In fact, it was quite the opposite. The Fed actually wants the economy to get worse. They want some kind of unexpected weakening to be able to cut rates. And if that's why the Fed is cutting rates, stocks are probably going to fall around 20%. With that said, the next Fed meeting is July 31st. From now until then, we will have another CPI report. We will have another non-farm payroll report. We will have most of your earnings out of the way for Q2 as well. We'll get a lot more information from now until July 31st. It's always possible that the Fed would be willing to cut rates by July 31st. But in all reality, if the Fed's going to cut rates July 31st, that's because something really did break. And in that scenario, stocks are not going to do well. So I don't know. Let me know what you guys think down below in the comment section. But on a scale of like 1 being the most bearish, sell everything, and 10 being super bullish, margin everything, drain the bank account, refinance the house to buy stocks, I'm at probably like a 2.5. Okay. I'm not selling everything, not at the 1, but I'm definitely looking at hedges in the portfolio. I'm definitely concerned over the next 3 months. I don't think Monday is going to be a disaster. I don't think it's going to be that immediate, but I do think over the next 3 months, we are set up for disappointment. And before the Fed, I was at like a 6.5, right? I was pretty optimistic, and that got way shot down. This data today as well just really is pushing the scale lower. So let me know what you think about this information down below in the comment section. Where are you at on your bull and bear scale? Are you at a 0? Or have you sold everything? Are you all in on puts? Well, where are you at? You on margin, going crazy? Let me know. I would love your thoughts down below in the comment section. I will actually go ahead and run a poll as well on this channel. So if you guys could do me a quick favor as well, go vote on that poll if you are still watching this video right now, because it will be posted on the channel. In the meantime, you guys have a great rest of your day. Hit the like button and subscribe to the channel on your way out of this video. You guys have a great rest of your day and a great weekend. I will see you in the next one.